Well, you're back for more. You're back for the third and last inventory costing video from Chapter 6, and we saved the best for last. Weighted average method. In the first video, we explained how we assume that the first units in are the first ones out. Second video, we assumed that the last units in were the first ones out, and now we're just going to take an average. And this is the weighted average method. So let's go back to our old trusty Kid Company example, same exact example we used for FIFO and LIFO, so you're familiar with the numbers, and let's jump right in. You can see the same old thing, 60 units in our beginning inventory at 22, 40 units in our beginning inventory at 23, and 50 units in our 50 units we purchased on December 6th at 24. So, as of December 8th, after the purchase on December 8th, we have a total of 150 units in our ending inventory. Notice I went ahead and multiplied through, got totals. So after December 8th purchase, we have a total dollar value of goods in our inventory of $3,440. So let's go ahead and figure up an average. And the way you're going to figure an average is you're going to take the dollar value, $3,440, divided by the number of units in our inventory, and that equals $22.933. I always like to go at least three places, round to three places just to make sure. One word of warning, sometimes students will look at the 22, 23, and 24 and go, oh, well, the average is $23. Well, no, the average is 22.933. You can't use the middle figure as an average because look at the number of units at 22. There's 60. There are only 50 at 24. So the $22 figure is weighted more heavily than the $24 figure. That's why the average is actually slightly below that 23. So make sure you go ahead and multiply through, add them up, and divide by the number of units to get the true average. In this case, 22.933. Okay, let's go to the next occurrence on December 10th. As you recall, we made a sale of 70 units, so we need to calculate the cost of goods sold. Very easy to calculate the cost of goods sold. We just simply take the 70 units that we're selling times our average of 22.933, and that equals cost of goods sold on December 10th of $1,605.31. All right, let's redraw our inventory. We sold 70 units, so now we have 80 units left at 22.933. And you can see I've reflected that right here, 80 units at 22.933. All right, next thing that happened is we made another purchase. Every time you make a new purchase at a different price or a different cost, you have to recalculate your new average. And that's exactly what we've done here. On December 17th, we purchased another 20 units that cost us $25 multiplied through, and that's 500. Add that to the 1834 that we previously have in our inventory, and that equals 2,334. We're going to divide that now by the total number of units that we have in inventory, 100, and you see we're doing that calculation right here, to get a new average of $23.346. So now, the way our inventory is, we have 100 units at $23.346. So I think you know what we're going to do now on our next sale. Our next sale is on December 28th. We sold 90 units, so our cost of goods sold is simply the 90 units times the 23.346, and that gives us cost of goods sold of 2101.14. What is our ending inventory now? Well, we had 100 units, we sold 90, so we now have 10 units in our ending inventory, and they will be valued at $23.346 each. So to calculate our ending inventory, we would just multiply through there 10 times 23.346, $233.46. Our cost of goods sold is the sum of the cost of goods sold of these two sales we made there. So we get cost of goods sold of $3,706.45, and that will go on our income statement as an expense called cost of goods sold. The $233.46 will go on our balance sheet as an asset. We can run a check here and make sure that the sum, and you can do this with FIFO, LIFO, and weighted average. It's a good idea to do it. Simply add your cost of goods sold plus your ending inventory, and it should equal the total cost of goods available for sale, the total cost of the goods that were purchased during the accounting period. And there's a little bit of rounding here. It actually comes to $3,940. So the total goods available for sale come to $3,940. So we're right there. We rounded by 9 cents. So you might want to add 9 cents to either ending inventory or cost of goods sold. So that's the weighted average. Those are the three methods of cost flow assumption. I have been kind of ignoring the fourth, which is specific identification. That method is not used much. It's, from an accounting perspective, it is a kind of a weak method, and it requires a lot of record keeping. Typically, it would be used for large ticket items. Specific identification is like the name says it is, where you truly know what is in your inventory. You have somehow uniquely identified each item in your inventory. It'd be like the chairs. I said here we've got all these identical chairs. It would be like you put some marker on them to indicate which chairs were the $22 chairs, which were the $23, which were the $24. Company's not going to do that. A company that's selling automobiles, each automobile has a different serial number. So they're already identified. So they would use a specific identification method of inventory. But most companies will not. So that concludes our Chapter 6 videos. Best of luck on working your homework, and we'll see you in the next chapter.